When we talk about wealth, most people immediately think about numbers. They think about charts moving up and down, headlines flashing red or green, and short-term decisions driven by emotion. But real wealth, and more importantly, real financial understanding, does not begin with price. It begins with systems. It begins with structure. It begins with recognizing when something quietly changes beneath the surface of the global financial order. Today's conversation is about one of those moments. Not a dramatic one, not a loud one, but a meaningful one. Japan has ended nearly 30 years of zero interest rate policy, and while many people were watching price candles, something much deeper shifted in the background. This is not about excitement or urgency, it is about understanding what changed, why it matters, and why assets like XRP are often discussed in the same sentence as these structural shifts. This discussion reflects my personal analysis and educational perspective only, and it is meant to help you think more clearly, not react emotionally. For almost 3 decades, Japan lived in a financial environment that most of the world treated as an exception. Zero interest rates were not a temporary response. They became a permanent feature of Japan's economic identity. An entire generation of global investors grew up assuming that Japan would always be the place where money was cheap, predictable, and largely frozen in place. That assumption shaped global capital flows, currency trades, bond markets, and institutional strategies across continents. When something remains unchanged for 30 years, it stops feeling like a policy choice and starts feeling like gravity. People stop questioning it. They stop modeling alternatives. And then, quietly, it changes. When Japan ended its zero interest rate policy after nearly 30 years, the significance was not in the size of the rate change, but in what it represented structurally. For 3 decades, global finance operated with the assumption that Japan would remain a permanent source of cheap capital, a stable anchor in a world of fluctuating monetary policy. That assumption shaped investment models, currency strategies, and institutional behavior across the globe. When an assumption lasts that long, it stops being questioned. It becomes part of the financial landscape itself. The moment it changes, the impact is not immediate noise, but long-term realignment. This shift should not be interpreted as a market event designed to trigger rapid reactions. It is a system-level reset. Central banks do not reverse multi-decade policies casually. Such a move reflects confidence that underlying economic conditions have changed enough to support normalization. It signals that emergency-era thinking is slowly being retired, even if cautiously. For investors and observers focused on structure rather than speculation, this matters far more than short-term volatility. The most important effects of this change will not appear on price charts. They will appear in how capital is modeled, how risk is priced, and how liquidity is managed across borders. Japan's zero-rate environment enabled certain behaviors to persist with little cost. Borrowing cheaply, parking capital inefficiently, and tolerating slow settlement systems were all manageable under those conditions. As that environment shifts, inefficiencies that were once hidden become visible. This is where structural stress begins to surface. From an investor psychology standpoint, this is often the phase where confusion sets in. Many expect immediate cause and effect reactions. When they do not appear, attention drifts elsewhere. But institutional finance does not move that way. Large systems respond slowly, deliberately, and internally before changes become public or measurable. The real work happens in reassessments, regulatory discussions, and infrastructure planning long before outcomes are visible. This is why the end of Japan's zero interest rate policy should be understood as a foundational change, not a headline. It quietly alters the background conditions under which global finance operates. When background conditions change, the relevance of certain tools and systems also changes. Infrastructure that reduces friction, improves efficiency, and supports cross-border liquidity becomes more important over time, not because of excitement, but because of necessity. Understanding this requires patience. It requires resisting the urge to frame every policy decision as an opportunity for immediate action. Long-term positioning is about recognizing when the rules of the environment are being rewritten, even subtly. Japan's decision is one of those moments. It does not demand urgency. It invites clarity. By focusing on systems rather than reactions, investors place themselves in a calmer, more informed mental state. They stop chasing outcomes and start observing processes. In the long run, this mindset matters far more than speed. Financial history consistently rewards those who remain steady, think structurally, and allow time to reveal the true impact of meaningful change. Most meaningful changes in finance do not happen on trading screens. They happen quietly, inside policy decisions, infrastructure upgrades, and institutional planning that rarely attract public attention. While retail participants tend to focus on price movement, professional systems are shaped elsewhere, long before outcomes appear. This difference in focus explains why so many people feel surprised by financial shifts that, in reality, were developing for years beneath the surface. Markets are often mistaken as the starting point of change, when in fact they are the final expression of it. Price reacts after structure moves, not before. By the time a chart reflects a new reality, banks, payment providers, and regulators have already adjusted their assumptions. They do not operate on emotion or momentum. They operate on risk management, compliance, and long-term efficiency. This is why watching infrastructure matters more than watching headlines. Investor psychology struggles with this concept because human attention is naturally drawn to visible signals. Candles, volume spikes, and short-term narratives feel tangible. Structural changes feel abstract and slow. Yet history shows that slow changes are the ones that last. When settlement systems evolve, when liquidity frameworks are updated, or when regulatory clarity improves, the effects persist long after market excitement fades. In this context, digital settlement assets like XRP are often misunderstood. Their relevance is not tied to daily movement or speculative enthusiasm. It is tied to whether they align with the direction of financial infrastructure. Systems are designed to solve problems, not to entertain observers. When inefficiencies increase, systems that reduce friction become more valuable. This value does not announce itself loudly. It is recognized internally through testing, integration, and gradual adoption. Another important aspect is time. Institutions do not think in weeks or months. They think in cycles measured in years. Their decisions are influenced by cost, reliability, and resilience under stress. This is why early infrastructure positioning often looks uneventful from the outside. There is no urgency because urgency is a retail emotion, not an institutional one. Stability and predictability matter far more. For individual investors, understanding this difference can be grounding. It shifts attention away from constant monitoring and toward deeper learning. It encourages patience and reduces emotional decision-making. Instead of asking what will happen next, a more useful question becomes whether the underlying system is improving or deteriorating. This approach does not promise certainty. Financial systems are complex and adaptive, but it does provide clarity. By focusing on structure rather than reaction, investors place themselves in alignment with how real financial change unfolds. Over time, this perspective fosters confidence without arrogance and caution without fear. In the long run, patience and clear thinking are not passive traits. They are strategic advantages that allow meaningful developments to reveal themselves at their natural pace. For a long time, global finance operated under conditions that made inefficiency easy to ignore. When interest rates were extremely low and liquidity was abundant, the cost of delay felt minimal. Capital could sit idle, settlement could take days, and cross-border transfers could involve layers of intermediaries without creating immediate pressure. These conditions shaped habits, expectations, and system design across the financial world. However, when the cost of money begins to rise, even gradually, those same inefficiencies become visible and difficult to justify. Rising rates change the psychology of capital. Money is no longer neutral when it is idle. Every delay carries an opportunity cost, and every inefficiency becomes a measurable expense. Institutions begin to re-examine processes that once seemed acceptable simply because they had always worked that way. This does not lead to sudden disruption. Instead, it leads to careful evaluation, stress testing, and selective improvement. Systems that redo CE friction move from being optional enhancements to strategic necessities. This shift has important implications for how infrastructure is valued. Settlement speed, liquidity efficiency, and reliability are no longer technical details. They become competitive advantages. In a world where capital must be deployed more deliberately, moving value efficiently matters as much as generating returns. The focus moves away from short-term performance and toward operational resilience. This is the environment in which foundational technologies gain relevance. Assets like XRP are often discussed in this context because they are designed to address inefficiencies at the system level. Their purpose is not to create excitement or promise quick outcomes, but to function as part of a settlement layer that supports faster and more efficient value transfer. Whether and how such tools are used depends on regulation, integration, and institutional confidence. These factors evolve slowly and deliberately, not through market enthusiasm. Investor psychology frequently lags behind these realities. Many expect immediate visible effects when conditions change. When those effects do not appear, interest fades or frustration grows. This reaction reflects a misunderstanding of how large systems adapt. Infrastructure responds on a different timeline than markets. The work happens quietly, through planning and incremental implementation, long before any results become apparent. Understanding this can bring calm to the investment process. It reframes waiting as observation rather than inaction. It encourages learning instead of reacting. By recognizing that rising rates expose structural weaknesses rather than create instant outcomes, investors can better align their expectations with reality. In the long run, financial systems reward efficiency, not emotion. Tools that reduce friction gain relevance when conditions become less forgiving. But this relevance unfolds over time through persistence and proof, not headlines. Maintaining patience allows investors to see these developments clearly. Maintaining clarity prevents emotional decisions, and maintaining a long-term perspective ensures that attention remains focused on the evolution of systems rather than the noise of short-term change. When discussing digital assets like XRP, it is useful to step away from speculative narratives and focus instead on function and placement within the broader financial system. Markets are often dominated by stories about potential outcomes, but institutions rarely operate on stories. They operate on utility. They ask whether something solves a real problem, whether it fits within existing frameworks, and whether it can operate reliably under pressure. From this perspective, XRP's relevance has always been less about attention and more about alignment with specific system-level needs. Financial systems are built around the movement of value, not the excitement surrounding it. At the institutional level, the challenge is rarely generating interest. It is managing complexity. Cross-border payments involve multiple currencies, time zones, regulatory regimes, and settlement delays. Each layer adds friction. Over time, that friction translates into cost, risk, and inefficiency. Tools that reduce these pressures do not need to be promoted loudly, they simply need to work consistently. XRP was designed with this context in mind. Its role is positioned around facilitating value transfer rather than representing a claim on future performance. This distinction matters. Speculative assets rely on belief and momentum. Functional assets rely on reliability and integration. One attracts attention quickly, but fades just as fast. The other develops quietly, often unnoticed, until it becomes embedded in processes that are difficult to reverse. Placement is just as important as function. An effective tool must exist where problems actually occur. In global finance, some of the most persistent problems are found at the intersection of currencies, jurisdictions, and settlement systems. Liquidity fragmentation and timing mismatches are not theoretical issues, they are operational realities faced daily by financial institutions. Assets positioned to address these issues naturally enter institutional discussions, even if they remain invisible to the broader public. Investor psychology often struggles with this quiet progression. There is a tendency to equate relevance with visibility. If something is not constantly discussed or reflected in market movement, it is assumed to be unimportant. In reality, the opposite is often true. The most impactful systems are the least dramatic. They function in the background, enabling activity rather than drawing attention to themselves. Understanding this helps set realistic expectations. Infrastructure does not move quickly because it cannot afford to. Changes must be tested, regulated, and integrated carefully. This slow pace is not a weakness, it is a requirement for stability. When viewed through this lens, periods of silence are not signs of failure. They are signs of work being done away from public view. For long-term thinkers, this perspective offers calm. It shifts focus away from daily narratives and toward structural fit. It encourages observation instead of reaction. By evaluating assets based on what they do and where they are positioned, rather than how they are talked about, investors align themselves with how real financial systems evolve. In the end, function outlasts speculation. Placement outlasts attention. Financial history consistently shows that tools designed to solve persistent problems gain relevance gradually through consistency rather than excitement. Maintaining patience allows this process to unfold naturally. Maintaining clarity keeps expectations grounded, and maintaining a long-term perspective ensures that understanding grows alongside the system itself rather than being swept away by short-term noise.